Everyone loves to talk about beating the market, but how do you actually measure that? The answer is alpha. I'll explain what alpha is, how it's calculated, why it matters to your investment portfolio, and how easily you can find it online. My name is Matt Maresh, your host, and welcome to Retirement Ready Nation, where we turn retirement jargon into plain English and strategy into peace of mind. So what is alpha? Alpha is a measure of excess return. It tells you how much more or less an investment made compared to what you'd expect, given the risk it took. It's often used to judge a fund manager's performance. Did they outperform the market after adjusting for risk? Or was the return just a product of volatility? For example, an alpha of 0 means the investment performed exactly as expected. An alpha of +1 means it outperformed its benchmark by 1%. Conversely, an alpha of -1 means it underperformed by 1%. How does it work? Alpha takes into account the market return and the investment's beta, which measures the risk relative to the market. So if a fund has a beta of 1, meaning it should move like the market, but actually earns more than the market, that extra return is alpha. It shows true performance, not just luck or market movement. Why consistent returns in alpha reflects skill and not just luck? When an investment earns a high return, the natural question is, was that due to a smart decision or just a hot market? This is where alpha steps in. Alpha adjusts the return of investment for the amount of market risk it took, using beta as a baseline. So let's break down a real life example. Suppose a fund has a beta of 1.0. That means it's expected to perform like the overall market. If the market gains 10% and the fund also gains 10%, its alpha is 0. It did exactly what it should have based on the market exposure. But if that fund returned 12%, the extra 2% is alpha. That's the piece that can't be explained by general market movements. It came from stock selection, timing, or strategy. In other words, alpha strips out the market effect and isolates the portion of return that came from manager decisions, not just being in the right place at the right time. Why luck isn't enough? Markets go up and down. Anyone can look like a genius in a rising market. But if a fund consistently shows positive alpha over time, especially in different market conditions, that's evidence of real skill. Luck is random. Skill shows up consistently in alpha. That's why professionals look at alpha when evaluating fund managers or investment strategies. It helps answer the question, are you getting what you're paying for? Why alpha matters. In retirement, as an example, you want your investments to work efficiently. A high alpha means you're getting more return without taking on more market risk. If you're paying for an actively managed account, alpha helps you evaluate whether it's really delivering value or if you should look at a different investment manager. Now, I know the community is asking, where do I find this alpha? If you're looking for sources to find alpha, you've got a few solid options. Your investment professional can provide you specialized research tailored to your specific investments you are considering. Fund fact sheets usually outline key details like performance, holdings, and risk metrics such as alpha. If you found this information helpful, be sure to like and subscribe to Retirement Ready Nation today. Want me to break down another investing topic? Please drop your suggestion in the comments below. I'd love to hear from you. This channel is for information purposes only. It should not be construed as tax, legal, or actuarial advice. Ashbury Boutique Wealth Management and the Leaders Group do not replace those professionals.